Good morning, everyone. Welcome to this update for the 3rd of July for global markets. And it was certainly another hedge scratching week. We had a big plunge the Friday before, followed through with an even bigger plunge on Monday, and then the most extraordinary rally that I don't think anyone could have possibly predicted. And amongst all this, we had an amazing surge in gold and silver, particularly the latter on Friday night. They were strong all through the week. They're just really defying the headwinds that exist at this time of the year and the particular circumstances that prevail at the moment with currencies and positions in the futures market. But nevertheless, it is what it is. I wouldn't have expected either stocks or gold to have done particularly well last week, but they did, and quite amazing. So let's have a look at a summary of what's going on around the world. So just from a big picture state of play point of view, in the last week, the uncertainties have become more and greater rather than less. So I don't think things are going to settle down surrounding this UK referendum vote. The more people think about the consequences of that, the more problem areas are arising. So I just think that the uncertainties are certainly going to keep mounting up. And it is possible that we could see over the next couple of years, we could see a breakup of the UK with Scotland leaving, Northern Ireland leaving, possibly Wales leaving, and also a partial breakup of the EU as well. So both of those events are now well and truly in play, and that would just be an extraordinarily damaging financial outcome for the whole world. As a consequence, nervousness around the markets and level of fear have risen, and that's why the rise in the stocks has just been so extraordinarily unfathomable. But there are some conflicting factors and signals, which I want to come to because that's really important. Now, I'm not buying that this rally is sustainable, and I'll give you several reasons for that. First of all, it defies some very major moves that we've seen into the typical safe havens of bonds, government bonds, and also precious metals. Bonds have continued to go up. Precious metals have just gone ballistic. So therefore, some serious money is pouring into those sectors, which means that money should be coming out of the stock market to do that. So there's this enormous contradiction between money looking for a safe haven and stocks or stock indices at least rising. However, we do need to keep that part in perspective, and I'll come back to that. So I think, to me, this has increased the odds that we may retest the August 2015 and January 2016 lows around 1820 on the S&P. I think those odds have certainly gone up. I'm not saying it'll happen, but they've gone up. But to me, I think the only course of action is to trade what you see, because if you try and guess your way through, or if you try and anticipate your way through how this may play out in Europe, there are so many different ways it could go that I think you're just guessing. So it's a pointless exercise trying to position yourself on what you think may happen. Just trade it as it is, as it comes, I think is the only way. Moving forward, the key issues for me, I think we're going to see a significant currency wars start up again. We're already seeing China doing some devaluation under the cover of all the Brexit turmoil over the last week. They've managed to pull off some devaluations that the market would have had a bit of a heart attack about. So I think we're going to see a lot more of this. The euro is going to be under pressure. Obviously, the British pound is going to be under pressure, so I expect those governments to try and do something about that. That will tend to force the US dollar up, which is the last thing that the Fed wants. So I just think everyone's going to go full bore on self-interest. The European banking system is in crisis if you really understand what is happening there. I expect that we'll see central banks continue to stimulate. I said last weekend to expect a number of coordinated actions. We've already seen announcements and moves from the British government, from the ECB, and also from the Bank of Japan as well. So that's already started to come through. The outcomes, it's going to be very difficult to see a sustainable positive outcome for stocks in general. Now, I need to distinguish between the stock market in general and precious metal stocks, because I think there's going to be two different courses being charted here. So really difficult to see a positive outcome there. I think it's why bonds and precious metals are really roaring ahead, because a lot of money is very, very concerned about the general stock market, and that's why the surge in stock markets over the last 3 or 4 days has just been so extraordinary. To me, the financial stability, certainly in Europe, is unraveling very, very quickly, and that's a real concern. The proof is that bond yields are rising. Bond yields are telling us that there's a serious problem, because, bond yields are going down and bond prices are going up. They're moving up in inverse directions. And the fact that bond yields, which were already at historic lows, managed to go even lower when stock prices were rising, just tells you something about where the smart money is going. The precious metals are telling us that financial stability is coming into serious question. Otherwise, precious metals wouldn't be doing what they're doing. European bank prices are telling us. Last week I showed a chart of Deutsche Bank, which over the last decade has reduced in price from $160 to 16. Now it's down to 12. And despite a bounce back in US banking stocks, the European banking stocks continued under pressure. So European bank prices are telling us, and have been telling us for some time, that there is a major problem. We're starting to see the progressive political disintegration of Europe. The left-leaning parties that want to leave the Eurozone in France, in the Netherlands, in Italy are gaining more and more traction. The heart of the issue, of course, is in Europe, where we've got a bunch of unelected and, to a large extent, unaccountable officials that are controlling the lives of 500 million people. And I think that is really the heart of the issue. The Brexit vote was, yes, it was about immigration and just the whole general deal that they get out of being in the Eurozone, but it was really about seizing back their own control of their own lives and country. And I think you're going to see this duplicated in a lot of other places. So Britain's really clawing back their sovereignty, and I expect others will follow. Moving on to the specific markets now, the S&P was higher by 66 points on the week, but I do note that it was led by defensive sectors. So utilities, real estate trusts, consumer staples, all the sectors that you would expect when markets are moving to a more conservative footing. They're the ones that led the rebound, not so much the aggressive sectors. The VIX index back below 14, which is just really extraordinary. I mean, the VIX index has dropped like there's just no problem at all. But the problems now are severe and far more varied. So to me, the market is surviving in the very short term on expectations about what central banks will do. And that's hardly a great environment to be in, where the market's being held up purely on what central banks do and the expectation of what they might do. Technically, as we'll see, there was a false break of the 2020 support, which I spoke about last week. That got broken on Monday, but then an extraordinary turnaround. And so I continue to reinforce that you should play it as it comes. Don't have any anticipated ideas of how this all may play out, because I just think the overwhelming odds are you're going to be wrong. Let's just play it as it comes. Let's have a look at some charts now. We'll start with the big picture on the S&P. This is the monthly chart looking at the last 18 years. And this is the month of June. So you can see we had a fair amount of fluctuation, but of course didn't get anywhere near the 1820 lows formed last year and again in January, February of this year. So really, we've just got, at this stage, we've got a big consolidation. We're back to the top of the range, which, given all the uncertainties now and the slow economic growth and just all the things that are against markets doing this, it's quite an extraordinary situation. This is the action from last week and a bit. The first huge red candle was Friday. That was the sell-off when the first of the Brexit was understood. This was Monday. We broke the 2020 support level, but then you can see immediately reversed and just rocketed straight back up again. But I hard to see how this is going to go much higher than this. Look, it might, and I'm certainly not ruling out that possibility, but it's certainly not going there based on fundamentals or value. The US stock market is valued for double-digit earnings growth in this coming year, and I think that's an absolutely forlorn hope that's going to come through. Looking at the US dollar, you can see we had a massive spike last Friday, but the rest of the week it just declined a little bit, so gave back a little bit of that massive gain, which is pretty much what you'd expect. There was a big overreaction on Friday, and the rest of the week didn't do very much at all. Turning to the VIX index, so we had a spike leading up to the Brexit vote. We then had a bigger spike when it happened, and then just look how quickly this has come back from 25, and now we're back down under 14. Investors are just, I think, living in a dream world that the market is just going to keep marching on because central banks are going to backstop it. And that's what's been happening for the last few years. It might keep happening for the next few years, but the further we go down this path, the more dangerous it gets and the more severe the consequences are going to be. And I think every investor just really needs to recognise that. Turning to Aussie stocks, our dollar didn't do much. It fluctuated around initially, dropped down to 73, but finished the week back near where it started at 75. So stay focused on the main trend, as I've been indicating. That main trend is down. I think all the circumstances are in place for the Australian dollar to be certainly in the 60s and possibly even in the 50s at some stage in the next year or so. The index was up by 134 points on the week, but that's a good part of that was just regaining what was lost the Friday before. So as you'll see in a minute, our index really continues to go nowhere. It's just caught in a trading range. So let's take a look first of all at the Australian dollar. So we're just bouncing around within this big price channel, which is roughly 12 cents wide. We're in the upper half of that price channel, but clearly the price channel is heading down. The Australian market, the index, you can see it's still just it's at the same level that it was at in August of 2015. So it's really just going nowhere. Turning now to precious metals, obviously this is the big story of the time at the moment. I believe that a long-term move in gold and silver is just beginning. So I've had questions and emails from lots of people pointing to the fact that some precious metal stocks have gone up 300 or 400% already, and that surely that's going to be it. I can assure you, on my assessment, I think we've got years to go and we're only just getting started. This is the first innings in a very long match. And on Friday night, it was almost panic buying, especially in silver. I've not seen that sort of strength on a minute by minute basis. It was extraordinary buying on Friday night. And caused quite a few precious metal stocks to actually easily break through resistance levels. Silver smashed through a resistance level at $19, as we'll see. And the interesting thing is to look what happened the last time silver did that. So those expecting a bit of a pullback, and I've been one of them, have now got to look at history now that we've broken that resistance to see just what gold and silver are capable of doing in a favourable environment. So we'll take a look at that. The last time silver broke through $19. Now, offsetting that, and this has really underpinned my caution over the last month or more, is that we've got a massive position, long position in the speculative futures market that doesn't tend to last, but this time it is. It's just not pulling back. Is that a symptom of the level of fear in the market that a lot of smart, educated money is just ignoring the normal patterns? And that money is just pouring into those sector at a great rate. I think there's a fair amount of truth to that. So I just raised the question, expecting a big pullback because the futures market has reached a certain point. Is that looking at this through the wrong lens? Are the circumstances different now to where they have been in the previous 3 or 4 bull markets? Because there's certainly no question that the financial system is stretched far, far more in all ways in terms of debt and leverage, government intervention, than it ever has been. So this is really a brave new world where we've not ever been before. So perhaps we need to start thinking that the precious metals markets will behave differently to what they've done in the past. So maybe we need to look at this through a different lens. And there's certainly plenty of evidence of investor buying, the amount of money flowing into the GLD ETF. There's no question, you can track it every day, that the amount of physical gold that's being built up in that ETF shows you that there is real money is pouring into this sector. And at the moment, it's completely overpowering any selling that might occur in the futures market. So gold stock and silver stock indices burst through some resistance. Last week, this is what I wrote, a possible progression, which was a little bit of navel gazing. It wasn't really a prediction, but just to give you some sort of feel for how this might play out. I suggested that gold would retest $1,300 before advancing, and it almost did that. It got down to 1306 and then finished the week at 1945. So a bit of a tick for that one. I expected that some of the overbought situation in precious metal stocks would unwind. That didn't happen. In fact, they just charged on even further. I said that the next major resistance for gold was around 1550, and given what happened on Friday night, that is definitely in play now. So sort of a tick on that one. Let's take a look at the gold market. So we'll start initially with the weekly. Let me just remove this, make it a little bit clearer. Okay, so we've had a big lift off the bottom at 1,050. We had an initial run. We had a very minor pullback, but really a consolidation period that lasted from February through to the start of June, and then since then we've just broken higher, and it's moving very strongly. Let's look at the daily. So there was the move on first of all Friday of the previous week, and then on Friday night just gone. But it was silver that was the really big move. This was huge for silver last week, and this $19 resistance was a key level. If we go back and look at where we were in 2010. So the gold market had recovered from the GFC. We ran up to this $19 level, first of all in December of 2009, pulled back, had another go at it in May of 2010, again in June of 2010. And then once it managed to break out, it just went straight up and went up to $31 over the space of the breakout occurred in September, and in the space of a little over 3 months, it went from 19 to 31 before we got a little bit of a pullback, and then it just exploded higher to get to $50. The way this market is shaping up, I I would expect that a similar kind of move is entirely possible. I don't know how it's going to play out, but there's certainly precedent there that once we get a break of this quite key level, that we could get a real charge forward in silver. Let's look at GDX as a bit of a proxy for what's happening in the gold market. You can see we had a key level of resistance here at $28, and the market paused there for a few days, but just went straight through on Friday night. And if you look at the silver ETF, it's an even more robust breaking of resistance. So there's no question, huge moves in the precious metals market. Turning now to other commodities, copper surged to $2.22, which was way beyond the currency movement, and I have absolutely no explanation for that because global growth is anemic. There are problems everywhere that could slow down growth even further. It would have been the perfect week for copper to go the other way, so can't explain that one. I'll just move on. Crude oil also a little bit higher, bounced from 47 to 49, and again I find that one pretty hard to explain as well, so I won't even try. There's the chart of copper. There's just some seriously weird things going on in financial markets at the moment, and that's why it's so important to trade what you see and not what you think should happen. So to wrap all this up, the overall strategic approach, look, individual stock selection is just absolutely critical. Last week I said that you really need to abandon old standard methods of doing things. Diversification for diversification's sake is I think going to be a significantly inhibiting strategy going forward. Just at the moment, I suggest that investors move to a more neutral stance rather than a negative stance. So I wouldn't get too anxious about the downside in the market because it's rebounded very, very strongly, and we have to acknowledge that. But I would certainly move to a bit of a neutral stance. So that involves having some cash and the preparedness to move in either direction. I think any earnings misses are going to be absolutely punished because the market is priced for earnings growth that I just don't think is going to materialise. So how that plays out in the Australian reporting season in August, how it plays out in the reporting season in America, which should start up soon, will be very interesting to watch. I expect there to be continued extreme volatility. I just think it's unrealistic not to expect that. And the key is just the balance, the sector balance you've got in your portfolio and how you manage it is absolutely critical. Precious metals, obviously, the mainstay for progress. Management of precious metal stocks is going to be tricky because the volatility, I think, there is going to be quite high as well. So certainly a lot to think about. But if you've been taking my advice and you've been building up exposure to precious metals, then you should have done extremely well in the last week. There's my contact details for anyone that would like some assistance. I can tell you it is going to be a highly rewarding period in front of us, but it's also going to be pretty tricky to negotiate. Unless you've got plenty of experience in these sort of markets, you might find that hard going. That's it for this week. Cheers.